Hi, this is Sherry, and today I'm going to be showing you a portfolio rebalancing simulator. So one of the questions that people often ask is, what should I actually do to rebalance my portfolio or to shift my holdings from one place to another? This is one tool that I built that can help you see what the difference is before and after some of the changes could be, and also look at some recommendations for what you can do with your portfolio. So let's take an example of somebody who is in their mid-30s with about $500,000 in net worth, and let's say that they are currently quite weighted towards large or big tech company stocks. This is actually this is a common problem among folks that are current or previous employees of big tech companies. So I'm going to just key in a sample portfolio here. So let's say that I work at Meta. I have 50% in Meta holdings. VU, which is Vanguard S&P 500 ETF. Let's say I have just 20%. I have Apple stock, I have Google stock, and let's just say I also have Amazon. So I'll just make these five. Okay, making sure I'm doing the math properly. Let's just do these as 10% each. Okay, so what this tool first calculate is actually an overall picture of your annualized returns since 2015 for this stock, or these returns are annualized across those years since 2015, and also look at something called standard deviation, which is at 40%. Now, standard deviation is a common number used to measure volatility of a portfolio because, again, investment returns are not guaranteed and you always have a range of different outcomes. So this just shows you how big of a range of outcomes you can expect. So as you can see, because Meta is 50% of this person's portfolio and the standard deviation is actually almost 80%, meaning it could swing this amount by one standard deviation any single year. That's why you have a large standard deviation of 40%. Now that's not always great because what that means is in a bad year you can actually lose or expect to lose 23% of your portfolio, which is a substantial amount, and it could be quite unfortunate if that is a year where you actually need to draw that money for life, right? Housing down payment or to pay for things for your family. So what I'm going to now do, instead of keying in what I think could be good new mixes for these different stocks, I'm just going to actually ask the LLM if there's any rebalancing suggestions for this current portfolio. What this is actually doing is taking into account information around the current portfolio, and then actually some of this information that I added in earlier on, like risk appetite, age, etc., to come up with some suggestion that I can look into. Now remember, none of this is investment advice. This is just a research tool you can use. Please do your own research and make your own investment decisions after seeing some of this as just an input. So let's just get rebalancing suggestions here. So I'm just going to wait for ChatGPT or OpenAI to actually run this. So you notice that it will give you an initial portfolio assessment, which actually says a lot of the stuff that I mentioned earlier on. But basically the heavy concentration in Meta is an asset allocation as well as concentration risk issue that somebody may have. And recommendation to kind of reduce some of this risk would actually be decreasing some exposure to high volatility tech stocks. Makes sense. There's a lot of tech stocks in this current portfolio. Increase the current allocation to a more broad-based index like a VU or Vanguard. And then actually they also suggested adding in some bonds as well. I think in the input earlier, I said that I have a moderate risk profile. So it makes sense that sometimes if you want to just have more income generating or more stable returns, you can also add bonds or bond ETFs into your portfolio just to give it a little bit less swinginess in the results. So what I'm going to do, which is very simple, is actually just copy and paste this and then add it to the table up here. And so then I can now go see rebalance portfolio review below just to see what some of the results are. And what you then notice is the new portfolio standard deviation is actually a lot less now, so it's at 21% versus the 40% before. Now you may note that the returns did decrease a little bit, and that's normal because usually your it's higher risk, higher return. So if you want to just de-risk your portfolio a little bit, the overall returns may go down just by a bit, but that's actually sometimes a wiser choice because, again, you don't particularly want to have huge swings in your portfolio if you want to have any kind of future proofing or visibility on your financial plan when making some of these decisions. And so when you have this rebalanced portfolio, the amount that you would lose within one standard deviation in a bad year is actually more around 8% than the 23% that you would see that you were seeing before. And you can actually just take these numbers here and then execute on the changes. So the math has already been done for you. This is a quick walkthrough of the portfolio rebalancing tool. Feel free to use it for the suggestions. Feel free to just use it to do the math more simply, but please leave a review in the comments of the video, and happy to see how this could be made more useful for you. Thank you.